Welcome everybody to November's 2023 market update with Jolene Moore. I'm Cindy Bishop with Cindy Bishop Worldwide. Our speaker, Jolene Moore, is a top producing lender. Her knowledge of market intricacies, as well as her attention to detail, cause her to be one of the best mortgage finance authorities in your market today. Jolene has an abundance of experience and a keen ability in the real estate lending field. She is not only a top producing lender nationwide, she is also the branch manager. And I don't know what to call you there, Jolene, with Cross Country Mortgage. She's in charge of her office. So that's what she does. It's a lot more than being under a company's, just being the vice president. She's the everything. And like I said, she is the branch manager there. She is also a well-respected and sought-after trainer with us, Cindy Bishop Worldwide. Over the next couple of months, Jolene will be offering some amazing training. I think all we have is market update for next month. But anyway, I should have updated this. And so just make sure you pay attention and sign up for the one in December. I think it is on, what is it on? I'm this 5th at 1 p.m. Okay, so everybody jot that down and make sure that you sign up for that. It's already on the citybishopworldwide.com to upcoming events. And if you look there, go to webinars, and there it is. So please welcome Jolene Moore, your presenter today. Take it away, Jolene.
Thank you, Cindy. Cindy, how many people did we have sign up today?
I think we had, I can't remember, like 29.
Okay, so hopefully more people step on, but thank you guys for being here. This morning, already the market has had some interesting, I guess, developments really related to the interest rates. So we'll get on into that. So like Cindy said, if you guys have comments or questions, please unmute yourself, put it in the chat, however you want to do it, so that we have some communication and, sharing of thoughts and ideas. Totally appreciate that part. All right. So, there was a lot of media going on relative to the past couple of weeks relative to interest rates. The one thing I will tell you guys to always keep in mind relative to the media is they are always behind, right? So whatever is happening in the media, what's ever being said in the media probably happened a week ago or several days ago. So it is not, especially when it comes to interest rates. So there was also quite a few, posts on social media and things like that, rates plunge, all that kind of stuff. We did not see rates plunge. We saw market improvement for sure. We saw interest rates improve, but we never did see them plunge, which, obviously would love to see and would be putting it all over if it really truly happened. I think, unfortunately, we can create confusion with clients because then they think that they should be so much better than they actually are. So I think we really have to be careful with the terminology we use when we talk about interest rates. So just to give you a little background of what's happened over the past few weeks. So obviously we saw rates move up, right? We moved up into the 8s, like high 7s, low 8s on a good amount of products, loan products and loan scenarios, especially if you're not a first-time home buyer, because there is first-time home buyer benefits relative to interest rates. And that's for just a traditional, conventional, Fannie Mae, Freddie Mac loan. If you make less than $180,000 in our market and you're a first-time home buyer, your rate can be 1/4 to 0.5% better, depending on the loan product. So if you're not a first-time home buyer, then the rates are actually, have it's even more impact on your purchasing power. So job creations came in, meaning every month, the first Friday of the month, the job numbers come out, and that's how many jobs were created the previous month is what they're reporting. So this month in November, the job reports came out and they were lower than expectations. And anytime the market is not, the economy is not going super strong, that's when mortgage interest rates are going to improve. Because when the economy is doing well, our rates are going to go up because they feel that the economy can withhold paying higher interest rates. When the economy is not doing well, that means the money is going to flood into the bond market, which is what controls long-term interest rates. And that's when we see interest rates improve. So with the job creations not being strong, which means there could be a cooling of the job market, which is what's driven our interest rates kept, to continue to rise, is because the job numbers coming out, showing that the jobs that were created were so much stronger than what they were expecting. And so that's what kept kind of, help pushing us up, as well as inflation. So the job creations came out in November, reports helped us, and we started to improve. And that's when we got, 1/4 to 0.5% better. Well, then last week, Jerome Powell, the Fed president, or Fed chairman, spoke, and he mentioned that he feels that the Feds may not have done all that they need to do to make sure that inflation continues to decrease, or inflation, I'm sorry, and so that they may not be done raising their rates. And when he made that announcement, then we saw our interest rates worsen again. So there's so many week to week, day to day things that are coming out that are causing reaction into the bond market, and therefore changing our interest rates. And that's one of the biggest challenges I think we faced since we started to see this rate shift and seeing rising rates, is the volatility. There's no consistency of like, okay, this is where we are and we're kind of just staying here. It's been up and down and flat for, small periods of time. So that's one of the, I think, the biggest challenges we face. Because I think for a while we'd stayed in the sevens for a little while, right? And then people started kind of getting, I wouldn't say used to it, but just kind of knowing this is what the market is, right? And so we started not seeing as many people saying, oh my gosh, rates are so high, so consistently. Well, then of course, then we go up higher into the high sevens, low eights, and then people freak again. So it's been a very fun, interesting year, that's for sure. So then this morning, the CPI, which is the core product index, came out, which is what is another test of inflation. And it's one of the biggest ones that the Feds watch to determine what's happening with inflation, came out, and it came in beneath expectations, which is good, again, for the long-term interest rates, because it means what the Feds are doing is having an impact, and we're starting to inflation moderate and come down slightly. So the bond market is rallying right now, which means our rates are improving. Again, when I looked at rates just right before this, just to kind of give you guys an idea, rates are in the mid to low sevens without points for conventional, and we're in like the high to low sevens, high sixes, low sevens on FHA, VA loans without points. Now, obviously, like I talked to an agent yesterday, and she's like, oh, this other lender says that it's 6.375 on VA. Yes, there's almost every rate can be out there. It's how much is it costing them to get that rate? And one of the things that I have a lot of conversation with clients about right now, relative to interest rates, is it worth paying points, right? How much is it costing us to buy the rate down? So what is the cost of the rate at the point? And then how much is it saving you? And then we want to look at that cost versus the monthly savings, and how long is it going to take you to recoup that cost? And does it make financial sense for you to, pay that cost? So because the expectation, when inflation does continue to moderate, the Feds stop raising their rates, potentially even cut their rate, we're going to see mortgage rates start to improve. The expectation is, there's been so many thoughts of when it's going to happen. It's going to happen. When, we don't know. But I would say 12 to 18 months is what I'm saying right now to clients. So if they're not recouping the cost within 12 to 18 months of that point that they're paying, how long is it going to take them to recoup it? And does it make sense to pay those points, or does it make sense to keep the money, help use that to make the monthly payment, and then be in a position to be able to refinance and not lose money that you've paid on points when you are wanting to look to refinance? So those are conversations that we're having a lot with clients. And then the government shutdown, again, we're looking at another deadline for that. So we will see the impact if that does, get updated and we don't have the shutdown. Again, if we do, just know that has, obviously, if anyone is a government worker and they stop getting paid, then in our eyes, they're not receiving payment. And so we are not able to use their income for qualifying. So we'd have to have backup plans, things like that. So something, unfortunately, that has been on our horizon that we've had to deal with over the past several months. So it's something just to keep in mind with your clients. So I wanted to show you when the core, the consumer price index, which is there's a headline and a core within that, basically. So I wanted to just give you guys an idea of like, this is the inflation numbers that came out today that drove, where we came in below expectations. So we can see we came down to 3.2 from 3.7 and 4% to 4.1. The goal for the feds is to get that to 2%. So obviously they still have work and room. Now, what they also, a lot of experts in our industry believe is that, they're looking behind as opposed to ahead too much, and that they could end up doing too much to push inflation down, which therefore could send us into a recession or hurt the economy too much. So that's the balance that they have to walk right now. But you can see, core, the rent, shelter, is obviously a big part of the consumer price index and dealing with inflation. But you can see lodging away, which is hotels, Airbnbs, things like that, was down. Energy costs, airline fares, used cars were down. Insurance, those are two things that were up the most significant this past month. And obviously the feds can't control that and can't, change their rates to change the cost of insurance. So those are things that are, a little bit out of their control, but you can kind of see what drove the inflation numbers today. And then I also wanted to show you guys a chart. So this is, you can see like right now, the bond market, which is what we watch daily, is up 63 basis points. When we see green, that means our rates are improving. When we see red, that means the rates are potentially worsening based on what the bond market is doing. So if you look at this, you can see from August. So this is where we are right now, as of today, right? And green, like we said, is good, right? And when the red means that the bond market closed, kind of like the stock market, it closed lower than it opened. And that's when we see, rates worsen that day. And you can see that we had quite a bit of red over here in September. And that's when we hit our, high marks. And then we had some green, and then we had some red again. So when you see like the rates plunging, obviously we've improved from where we were, the last week of October to now. So that's great. But you can also see that we're still not, back in where we were in mid-September, things like that. So that's where that's like, you have to really kind of keep in mind the terminology relative to rates plunging. So just to give you some insight of like kind of where the market has been, and you can even look at back in the past year, you can see where we were back in April and May. And, I think that was the last time I locked a client in at 5.99% was back in May. So we've obviously seen a lot of downward in the market since that time in interest rates. Anyone have any questions on rates, on this information, on the chart, anything like that? The other thing, I did not put on my anywhere else. I'm going to bring this up. And I had a client agent call me yesterday, and she's like, I can't be on the market update today, or I'd be asking you these questions. Has anyone dealt with a 2-1 buy down yet lately in the current market? Does everyone know what it is? I got to have someone that speaks up today.
I've heard of it, but clueless on how it really works.
Thank you for that. Okay, so let me explain it. So I'm gonna actually bring up a chart that we did for a client to show you guys what it looks like. So what a 2-1 buy down is let's say today the market rate is 7.5%. And we're going to buy the rate down temporarily. So it's a temporary buy down from 7.5% for 2 years. The first year would be at 5.5, and then the second year would be at 6.5, and then the third year is going to be at the 7.5, and the third year on. So what that means is that the best way to do this is to get a seller concession to cover the buy down, which means that you have to ask for a seller credit to be able to cover the buy down to give you enough money to do that. So I'm going to show it to you. This is a scenario that we put together for an open house that a client of ours, a realtor, was doing. We put together flyers. So if you guys ever need these, reach out to us and let us know. So this was a 558 sales price with 5% down. This was based on the end rate was 7.95. The start rate was 5.95 for the first year, and that puts their payment at 3774. And then the cash to close was 43,490. That's just the down payment and closing costs. The cost of this buy down for a seller, I think, was about $12,000. So it means that we'd have to get $12,000 from the seller, and the money, that $12,000 goes into an escrow account. So it goes into the escrow account, and each month, this is the payment, the principal and interest payment based on 5.95. This is the principal and interest payment based on 7.95. So you can see there's a difference of about, $680. So every month, $680 would come from that escrow account that we have set aside for the buy down for the first year. And then the second year, you can see the difference is about $347. So then the second year, $347 is taken from that escrow account to make up the difference between the bought down rate of 6.95 and the final rate of 7.95. So what happens is, let's say this first year, they're at 5.95. This is their monthly payment for principal and interest. After the first year, the market is improved. We now are in the position to be able to refinance them and go into a permanently lower rate, not just a temporary lower rate. And there's money left over in that escrow account. Any money that's left over and set aside in that escrow account gets refunded back to the borrower, and it reduces how much they owe on the mortgage. So after that first year, let's say they owe $315. After that, and they still have $5,000 left in their escrow account, they now only owe $510. I'm sorry, instead of $315, $515. Now they owe $510. So when we go to pay off that loan, that's how much is due to pay off the loan. So they do get the money back if they don't use it all. And so it's a great product right now for clients to be able to use with affordability, to have a lower interest rate for the first 2 years, to not lose the money that they're paying, because we're just talking about points. And when you pay points and you refinance, you lose that money, right? That's a one-time cost that you permanently buy the rate down. But if you pay that loan off too soon, then that money could have been wasted. This money is not wasted because it goes aside into an escrow account and it comes back to you if you do pay the loan off early. Obviously, we have the conversation with clients who want to make sure, like I had a client yesterday that closed on the 2-1 buy down. At the closing, they get a disclosure that says, here's what the rate is, the payments are for the first year, the second year, third year. All the payments on the documents reflect what the actual payment is for the third year, because we have to make sure that they are aware that the payment's going to go up, that this is the final payment that you actually will be responsible for after the first 2 years. And that's what we qualify on. We have to qualify on the higher interest rate as well. So it doesn't help with qualifications. It simply helps with monthly payment and affordability. So if you have, this, is a market where, last year in the fall, we saw these start to become more prevalent. I've been doing this 20 years and I'd never done one up until last year. But obviously I hadn't seen rates in this market since I've been in the mortgage industry. So if you have a property that's been on the market for a little while, that you feel like you have negotiating power, rather than lowering the sales price, which is not, if you lower the sales price $12,000, you're going to save the monthly payment about $84 a month. As opposed to, you can see here, we use that $12,000, that saves in, $600 and some dollars, $680 a month. That's just not the same swing, right? So, and also if you're on the listing side, rather than lowering the sales price 20,000, 25,000, which we see a lot, think about offering a 2-1 buy down. And that's what we did with this client, this agent that had an open house over the weekend. Her house had been on the market for a little while, wasn't selling. Her seller was agreeable to offering the 2-1 buy down. So we put together a flyer with these numbers so that they could show the buyers when they come in, here's what the seller's willing to provide. And this is what you as a buyer is going to potentially get and how it's going to benefit you. So this is a good tool for you guys to use on the listing side as well as the buy side.
Hey,
Anyone
Jolene,
have questions on that?
Jolene, is there any penalties on that to, like, if you sold it or if you paid it off?
Nope. That's what I'm saying. No matter if you pay it off either through a refinance or selling the home, any money that's still left in that escrow account would be coming back to you. When it's provided by the seller, or a builder. If, there's people out there that mention like a lender paid buy downs. The downside of those is, one, we have to increase the rate so much, it almost offsets the benefit of trying to do a 2-1 buy down. But if you pay that loan off and the funds were provided by the lender, you don't get them back. So the seller and the builder, kind of buy down concessions are the best way to go.
So there's no time frame either.
Nope.
I mean, if I bought it, and decided in 12 months to sell it, there's no time frame on that.
Nope.
Okay, thank you.
No prepayment penalty, nothing like that. And you still have the ability to recast, like we've talked about in the past, if you wanted to recast, pay down the loan after you sold a house, things like that. So it's a great, and there's also 1-year buy down. So let's say you can't get $12,000 because that's just a lot of credit and you don't have that much room. There's also, we could do the 1-year buy down where we just buy the rate down to 6.95%. So we're buying it down 1% for 1 year. That is going to be a lot cheaper. So if you feel like, oh, I don't have enough, negotiating power to get this much, well, then let's talk about doing a 1-year buy down. So there's different options of how to do the buy down as well to reduce the cost. Anyone else have any questions? Does that make sense? Do you guys feel like that can be helpful to clients in this market, and especially, when we get into the traditionally lower, slower months anyway, because of the winter. We see houses maybe not moving as quickly. So this might give you guys some ability to get some buyers into the market right now. All right. Okay, so, I talked about this a little bit last month. I just wanted to touch on it again. And, and this is where, thinking about our clients and thinking about like the potential of a recession, thinking about, the affordability for clients and challenges to get into the market, know that if you look at statistically, like households have less in savings and they have higher credit card debt. But a lot of buyers have equity, right? A lot of homeowners, I mean. So thinking about from average loan to value of a home in 2023 is 42% versus 82% in 08, right? So that means a majority, the average person has 58% equity in their home. And so that means average equity and this is nationwide, not in our area, is $249,000. So the thing that to keep in mind, I'm going to go over this in a little bit, but I have two loans this month that are refinances, right? And one of them is a buyout of inherited property. They have to buy out a family member of what they owe. The other one is a cash out refinance on an investment property because they want to do renovations to the home. And they also have a really high home equity line of credit that has a super high payment on it. So there's a lot of clients and people and homeowners that believe, oh my God, I have an interest rate of 3%. I don't want to touch it. Well, the thing to keep in mind is if they have credit card debt, right? And we have less savings and the average rate on a credit card is 25%, it may still make sense to do a refinance to pay off their current mortgage, combine any other, revolving debt they have, or even if they have car loans, even if it's a home equity line of credit is higher than what the current interest rates are as well. It may make sense to look at doing a cash out refinance to combine all of that debt. So just keep that in mind as you're talking to clients and not believe that just because they have a 3% interest rate doesn't mean that there's any value to them to talking to me or to someone else to figure out, could this put them in a better financial picture? Maybe they're not ready to sell their house right now. Maybe it'll be in a year. Well, let's refinance them now, get them out of debt, get their credit score improving, get them in a better financial picture so that a year from now, they could look to, sell or do something different. So definitely keeping that in mind when you're talking to clients, because there can be still a lot of value for clients with the amount of equity that's out there. All right, so later this month, we'll obviously have Thanksgiving next week, and around that time frame is when Fannie and Freddie announced the new loan limits. And, you know, right now, our conforming loan limit cross country has increased it without knowing exactly what Fannie and Freddie are going to do. So our temporary conforming loan limit was increased to 750. It was 726. And so now it's gone up to 750. So any loan that's below 750, we can do as a conforming loan, which obviously helps with interest rates and down payments, because that means you can do 3% down payment if you're a first-time home buyer up to the 750 loan amount. You know, like I said, they'll be announcing coming in the next couple of weeks. So be lookout for us sharing information on that, because the jumbo loan right now, anything above 1.089 is considered a jumbo loan. So that should be increasing as well. So we'll see what that will do. And obviously that can be very helpful in our market to know, you know, if they increase that above 1.1, you know, that helps that purchasing power to be able to still only put 5% down. So we'll be announcing that once it's comes out in the next couple of weeks. We have a new program Cross Country does. It's called Bye Bye MI. And basically it means that we have if you put 15% down, there's no mortgage insurance. And this is on a conforming loan. So it's a Fannie Freddie loan. And the good news about this product that I think is exciting is most of the time when you see a loan that doesn't have mortgage insurance, the rates are going to be higher, right? Because the mortgage insurance is absorbed into the rate, and that's how they're offering it with no mortgage insurance. That's what a lot of credit unions do. Right now, this product actually has a better interest rate. It's the same, and that some days it's even priced a little bit better than those that we're actually charging mortgage insurance. So that's a huge benefit right now in our product mix. So you have clients that, and this means like they don't have to put 20% down to not have mortgage insurance. They can do 15% down and use those funds to, you know, do some renovations or just invest or keep in a rainy day fund. So ways for clients to not have to put so much down and not worrying about paying mortgage insurance. We recently have had an influx of clients coming to us wanting to know if we do a doctor's program, which we do offer. We offer the doctor's program. I think it's up to 1 million with 100% financing. It might even be 1.5, and then after that, it's 10% down. So no MI, some more flexibility on income when they're starting their job, things like that. So if you guys have a physician, you know, that's interested in purchasing a home and maybe they don't have the 20% down and they want to go to a higher price point, you know, 1.5, 1.6. This could be a way for them to be able to get into a home with less money down. And the other crazy thing, you know, when my previous company before coming here, we had a limit. If you did over 1.5 sales price on VA, you had to put at least 5% down. I priced out last night just to see, because I had another client I was looking at. We went up to 4 million. I stopped at 4 million, but $4 million with 100% price point. So that's not too many times you're going to find, you know, someone buying a $4 million home with no money down. But just know that we do have the availability to go very high on a VA loan with 100% 100% loan to value. So we've done it. I had one at 1.1 a couple last month. We've had 1.25. So there's definitely clients out there that are looking for it. And then you all should know student loan payments started again in October. So we are now seeing, when we run credit reports, now we're starting to see monthly payments listed on there, because in the past, you know, 3 years, we've had to calculate the payments ourselves. Now, the other thing that clients are needing to do, so just something to keep in mind, is that if they had like a payment plan based on their income, they're going to have to, you know, redo those, show their current income and have those payments regenerated to determine what they are based on their income. And they'll get letters from that. So if that's the case, we always ask clients, you know, if they have a payment set up, and we'll get copies of that documentation to show what those payments are so that we can use those. Now, not every loan product allows you to use it. Some of them require you to use whatever's on the credit report, even if it's higher than what they're actually paying. So it depends on the loan program and whether or not we'd be able to use the lower more student loan payments that they've gotten based on their income. Anyone have any questions on these different new and updated products? All right, so tips from last month's. Yep.
A quick question. So the doctor program, that's the physicians program, like to assist physicians with their with getting a mortgage.
Mm-hmm.
Okay, just making sure.
Yep. Oh, and I think I skipped over this, the grant. The FHLB grant is, so this is a grant that's out there. It's Atlanta Bank that puts this grant out. They ran out of funds, but they just announced that they did got more funds last week. I think it was $4 million. The unfortunate thing is it's probably going to go very fast, but if you have clients, this grant is up to $15,000 on conforming loans, conventional Fannie Mae, Freddie Mac loans. It's for first-time home buyers, but it's also for teachers and law enforcement. So if they're not a first-time home buyer, but they're law enforcement and teachers, and I think emergency workers, then they have the ability to get this grant and not have to be a first-time home buyer. So if you have clients in those areas, this would be a time to reach out to them to let them know they might have the availability to get grant money, because that money is going to go fast. It always has, and it will as well. So something to keep in mind. All right. I always kind of like to share things that happened last month and some tips and things that we saw that worked for us. So one, I mentioned the doctor's loan, the physician loan. And I had a client that came to me that was a doctor and wanted to talk about the doctor's loan, but it was also a veteran. The husband was a veteran and the wife was the doctor. And when we looked at both products versus the doctor and the VA was definitely much more beneficial to them. The rates were higher. It was 100% financing at the price point they wanted, more forgiving on debt to income ratios because we were carrying a house, things like that. So just know that when you refer a client to us and somebody says to me, I want to do the grant program, right? Or I want to do the doctor's program. We're not just going to focus on just that one program, which is what you do get when like clients call 800 numbers and things like that. They're going to be like, oh, this is what I want to do. Okay, here it is. And they move on. We're going to look at the whole picture and look at all their options and help them make, best, educated choices based on the financial situation and what makes the best financial sense for them. So in that situation, the VA loan made more sense. The listing agent was, fortunately amenable to that and accepted their offer using the VA loan. So, just know that, that we're going to look at all of the options for our clients. So I was talking to an agent yesterday and he was asking me because we're having a good November, and he was asking me where are your transactions coming from? Who are they made up of? So I looked at them, and out of our transactions, I think we have 11 of them in November. Out of those 11 transactions, 83% of them were first-time home buyers. So obviously that's a big driving force in the market. I think statistically it's over 50%. So over 50% of the purchases made this year in 2023 have been first-time home buyers. And I would say this month was also lower priced homes. So condos, things like that. And I think that's what I saw last fall as well, when the market shifted and when interest rates move up, is, some of those larger price points get hit harder when the rates move up, right? Because it's a bigger difference in the monthly payment than it is when you're looking at some of the smaller sales prices. And obviously I know they're not small, relatively speaking, but in our market, they're on the lower end. So that's something to keep in mind. Well, you got to shift with the market, and who are we trying to follow up with? Who are you trying to convert? And know that where things might move a little faster in this market than others that may not. So 83% of our November transactions were first-time home buyers. Like I said, 17% were cash out refinances. So we have, it was I think we had one, and so probably the percentage should have been a little bit lower. We had one move up buyer out of all those. The rest were first-time home buyers or cash out refinances. So the move up home buyer, is again, we, have conversations about bridge loans, getting home equity lines of credit, things like that. They needed the mom and daughter to co-sign to be able to carry the current house and buy the other house. They had a very large down payment, so there's still, plenty of buyers out there that have the opportunities in this market. It's just about making sure that we're helping them understand what those opportunities are. This past month was crazy. We had several VA loans. I think we had 3. I think one of our appraisals actually came back in 2 days. I could not believe it on a VA. So again, I always share about VA because there's so much, misconception about that those appraisals, we've closed many VA loans in 2 weeks. And we've gotten appraisals back very quickly and at sales price. We've had some come in, but lower. We've had some come in lower on conventional. So it's across the board. It's very similar. Repair escrows, that's come up several times for us over the past several months. And I just want to always caution you that anytime you're thinking about repairing for escrows, you need to talk to the lender as soon as possible, because we need to be aware of what you're trying to do and whether or not it's going to be allowable. Because there are some repairs, any repair you're going to do that you want to escrow for, you're going to have an invoice. And you're going to have to plan to escrow 1.5 times that invoice. So if the cost of the repair is $5,000, you're going to have to escrow $7,500 to make sure that you have overage. So they, anytime work is done, we all know that, contractors are like, oh, it's going to be $5,000. And then they are like, oh, well, I found this, or, oh, I need to do this, or I need to do that. So there is an overage that's required. So it's going to be 1.5 times the invoice amount. So, you're doing a walkthrough and you're like, we need to escrow because they need to repair, make sure that the dishwasher is working. So we're going to want to do an escrow repair of this. It's not as simple as that, unfortunately. You have to have the invoice, you have to have an contract already lined up and getting an estimate, all those types of things. So obviously the easier thing is to get a seller credit, towards closing costs if you haven't reached that max yet. If there's a contractor that is going to do the repair work, and maybe you don't have an invoice, or you have an idea but you don't have an actual invoice, you could put it on the seller side. So as long as it's paid by the seller to the contractor, then the lender doesn't have to get involved. So there's ways to work or with it. You just got to communicate so that we can help you set it up properly. I have a USDA client right now. So, letting you know we can assist in any state. I have a colleague that's in West Virginia. I'm not personally licensed in West Virginia. So I had a client that came to me that was looking to get pre-approved to purchase here in Virginia, decided instead to buy in West Virginia. So we helped him kind of initially get pre-approved, figure things out, get under contract. And then now he's working with our colleague in West Virginia to do the USDA loan, which is 100% financing. It's only specific rural areas that you have to look up to see if the property is approved. But that is, something that's definitely potential. And the rates were better, were better than what they would be getting, a better scenario than if they were doing like the first time home buyer program with Virginia, which we did close our Virginia housing loan yesterday. And I'll tell you what, the Virginia housing personnel, the people that work at the Virginia housing are the most helpful, friendly people. So if you guys ever have questions on Virginia housing and you reach out to them, you're in good hands. Their turn times were fast, and they're just very accommodating and very helpful to help you get things done with them right now. So I can't say enough positive things about them. Anyone have any questions on like tips from last month? All right. So what are you if you guys can just give a little bit of insight of what you're seeing in the market. I know there's obviously the case, the thing about the buyer compensation for, the buyer realtor compensation and what's going to happen with that. I had a conversation with an agent yesterday, and he was mentioning he's seen a couple listings that have mentioned like zero for compensation to the buyer's agent, $500. I know there's so much unknown about that. So we're going to, have to wait to see how that kind of all flushes out. But it obviously means that you guys are going to have conversations with your buyer's agreement and be able to kind of explain more to that about when you see listings that may not be offering the compensation to you all. So it's definitely something I'm sure you guys are aware of with your brokers and staying in the know, but, things to see, keep on the horizon and, really start to create your scripts and be comfortable with having those conversations with your buyers clients going forward, because it's definitely going to be something you're going to have to be much more aware of based on all of that. Anyone have any experience with that yet? Have anyone seen any listings relative to that?
Hey, Jolene, is it looking like we're going to be able to finance that in the loan in our future?
I haven't heard anything about that being possible now. I mean, I think it's going to be negotiating from on the seller side, needing more funds from the buyer, things like that. But no, I haven't heard anything about it being part of the lending changes.
Because a lot of them, they don't have the money. When you come in at 100% financing, they don't have the funds. And
Right. So it might be, having to negotiate it on the
is it
sales.
FHA or VA that might not allow that too?
I haven't heard, I mean, that's the thing is there's so much unknown about it that I don't know. But I mean, again, that'd probably have to be on the seller side. And so it's part of the, like we were just talking about, like how the VA doesn't allow you to pay the admin fee for brokerages. So you have to put that on the seller side and negotiate that as part of that. So it's going to be, some of those things that we're going to have to kind of tweak and work with. All right, any things that they're seeing in the market? Are you guys seeing the houses? I had another agent yesterday to closing told me that they had offers that a property that got 41 offers. Has anyone seen anything crazy like that? Are you seeing things slowing down a little bit? What kind of your pulse been on the market?
Most of the houses my clients are bidding on, they do have multiple offers. I've only bidded on one where we were I think the only or the second offer.
So you're still facing competition for the most part.
Yeah.
Are you escalating or going in at sales price? Like where are most of them ending?
We were able to go in at sales price. Well, actually, we went a little under sales price for the one we were able to get. It was an as is, which was great. The other ones we did go under sales price and we lost and had competition.
Okay. Yeah. So, I mean, the good news, it sounds like when you have the multiple offers, you're not escalating like we were, right? And that's where I think we also need to get out into the market to let buyers know. And that's the conversations I'm having with the buyers I'm talking to now is, this could be a market, like Mary Lou, you were saying, if you don't have extra funds beyond what you need for closing, now is the time to get into the market because you're not potentially having to waive, appraisal contingency. You're not having to escalate. So you don't necessarily have to have extra funds to make up differences that you will when rates improve, right? Everyone wants to wait until interest rates improve. But when that happens, the competition is going to be more vast and it's going to be harder for first-time home buyers that have limited funds or buyers in general who have limited funds. So this is the market that we got to make sure everyone is aware that, to take advantage of. All right. Well, thank you all very much. Appreciate you. If you guys have any questions, anything we can do, if there's any clients that we can help, please reach out to us because we would love to be of assistance. And if I don't talk to you before Thanksgiving, I hope you have a wonderful holiday.
Thanks, everybody. And this
All right.
recording will be on Jolene's instructor page at cindybishopworldwide.com. Okay.
All right. Thanks. All right. Bye,
Thanks.
Cindy.
Bye.